Norbert Lou of Punch Card Capital is one of the world's most successful yet least well-known super investors. He first made a name for himself by writing on the Value Investors Club under the alias Charlie 479, and he actually won 6 of the bi-weekly prizes for the best write-up on the Value Investors Club, winning $5,000 as a prize each time. In fact, Value Investors Club founder Joel Greenblatt, a super investor in his own right, actually shared several of Norbert Lou's write-ups in a 2005 lecture at Columbia, which can be found here on YouTube. And Joel Greenblatt's Gotham Asset Management actually seeded Punch Card Capital and helped the fund to get started back in 2004. This video is going to be the first in a 3-part series looking at some of Norbert Lou's best ever investments. I've gone through this exercise now with Warren Buffett, Charlie Munger, and Lee Lou, and you guys really seem to like these types of videos. So thanks for the suggestions of all the new investors that I should possibly be covering in a series like this. Norbert Lou was suggested in the comments a few times. So here we are looking at a 3-part series on some of Norbert Lou's best investments. Now, unfortunately for us, fund updates from Norbert Lou and interviews with Norbert Lou are very rare. In fact, I've never even seen a picture of what Norbert Lou looks like. But luckily for us, the old Value Investors Club write-ups are still available for us to go and read. Back in 2011, Norbert Lou did give a rare interview, and he shared that since inception in 2004, Punch Card Capital had generated 14.5% annualized returns from 2004 to 2011. That compares to only 2.2% in the S&P 500 over that same time frame. All the while, he used no leverage. He had on average about 25% of the fund in cash, and he had about 90% of his own personal net worth invested alongside his partners in the fund. Now, if you want to check out the full interview with Norbert Lou, I will leave a link to the article down in the description below, and this video is going to cover an investment that was talked about in that article that Norbert Lou actually made in an Argentinian beer company called Quinsa. Now, Norbert Lou, unsurprisingly, is quite a big fan of Warren Buffett and Charlie Munger. And in Poor Charlie's Almanac, there's actually a speech that Charlie Munger gives, basically breaking down and kind of reverse engineering the success of Coca-Cola and their successful investment in Coca-Cola. And some of the lessons from that speech by Charlie Munger actually inspired this beer company investment in Argentina from Norbert Lou. The speech that Charlie Munger gave was very qualitative. It wasn't really looking at financial statements for Coca-Cola. It was more talking about things like economies of scale, universal appeal, a strong brand. And Norbert Lou noted that you can identify certain business momentums in the real world that aren't necessarily the financials and allow for sustained high returns on capital. Now, coincidentally, around 2004, when Norbert Lou was in the very early days of his fund, he actually traveled as part of a holiday to South America and to Argentina. And he noticed a very dominant kind of beer brand in Quilmes, I believe I'm pronouncing that correctly. He basically said, I remember seeing it everywhere. Sometimes alternatives to that brand were not even available. He'd previously spent quite a bit of time basically just learning about beer businesses and reading annual reports of giant, very highly valued beer companies like Anheuser-Busch and like Heineken, but he'd never made an investment in any of those companies, basically just because they looked too expensive. But in the summer of 2004, he actually came across a press release from a company called Quinsa, which owns the Quilmes beer brand, essentially. And the press release explained that they were looking to pursue something called a Dutch tender offer for a large portion of their shares, which is essentially just when a company tries to do a very large purchase, oftentimes buying out quite substantial shareholders for essentially the lowest price they can. And this is what really prompted Norbert Lou to look much closer at the underlying company. Now, there were a few things that kind of initially jumped out to Norbert Lou. Firstly, there really were a lot of people that were turned off to the idea of investing in a place like Argentina. There were very high interest rates, there was a lot of inflation, and the stock market had kind of just been depressed for a long period of time. But for that reason, when he looked at the kind of Quinsa company, he saw that it traded at about 6 times operating earnings, which made it just about the cheapest beer company he had ever seen. trading at much lower multiples of earnings than companies like Heineken and Anheuser-Busch and so on. He mentions in the article that a critical thing was having some belief that just because it's Argentina doesn't mean you can't have a good company, and if the country blows up, it doesn't mean all the companies will be a disaster. So after a deeper dive into the company, Norbert Lou basically discovered 3 different things that made it a really interesting potential investment case. Firstly, he found that Quinsa had massive market share. They'd been around since 1888. They had 80% market share in Argentina and almost 100% market share in Bolivia, Paraguay, and Uruguay. And he was kind of asking himself the question, why is that? And to a significant extent, he said, one of the things that's so special about beer is this natural tendency for the industry to consolidate and for all the advantages to accrue to the largest player. He noted that lots of consumers tended to identify with a particular beer brand. In the US, someone might identify as a Budweiser drinker, for example, as something that he mentioned. And he mentioned that as the brands kind of start to build and scale up, there's sort of this self-reinforcing process where the beer brands that have the most sales tend to have larger advertising budgets. That tends to lead to more sales. It tends to lower their cost of production because they can scale into much larger production facilities. And it just makes it really hard for other beer brands to compete, essentially. Even very well capitalized international competitors can come into a market with their, fancy new beer brand, and they're going to find it really challenging to displace the beer brand that already has significant market share and that consumers are really identifying with personally. All of that resulted in a couple of different things. It meant that Quinsa had about 60% returns on invested capital, and they'd survived a very long time. They were founded in 1888. They'd survived wars, military coups, and hyperinflation. And the third thing that Norbert Lou really liked about the business is he felt that it had a degree of untapped pricing power. He explains that for most companies, in order to increase your revenue, you tend to have to kind of increase your expenses as well, whether it's marketing or producing more units of whatever you're selling. But he said with a small minority of companies, you do have true pricing power. You can put up the price of your products without necessarily having a material impact on the volume of that product that you're able to sell. And if you can increase your prices and keep your expenses relatively flat, that can do great things for operating margins and operating profits. He noted 2 things with this particular company in relation to pricing power. Firstly, people identify very strongly with the brand of beer that they drink, and they're more than happy to pay a modest premium to other, competitive brands if they can drink the brand that they identify with and that they're used to. And he also said that the Bemberg family, who had controlled the company for several decades, had actually for a long time been raising the price at a far slower rate than simply the rate of inflation. And for that reason, he believed there was quite a bit of sort of latent pricing power built in here. Now, the final sort of complicating factor that was happening at more of a kind of corporate level as opposed to the qualitative aspects of the business was that there was this quite complex put-call agreement between the Bemberg family, who controlled most of the shares in this company, and Ambev. And it essentially meant 2 things. One, the Bemberg family had the right to sell their stake, and the Ambev company had the right to buy those same shares at certain times in the future. And after doing some kind of deep digging into various SEC filings and so on, Norbert Lou was basically able to find that the price at which those transactions could potentially happen was very heavily influenced by the EBITDA of the business. So you had kind of a lot of things really aligning here for Norbert Lou. You had basically the world's cheapest beer company. You had a very dominant market position. You've got the lowest cost beer producer in the region because of their immense scale. You've got untapped pricing power. You've got a family looking to sell for the first time in generations. You've got that family incentivized to maximize earnings more than ever. The simplest way to do that, of course, is to tap into some of that latent pricing power. And all of these factors working in harmony created a very, very compelling investment case for Norbert Lou. Now, in terms of the timeline here, Norbert Lou was doing most of this research in mid 2004, and the sort of price increasing game had actually already started back in 2003. So, in 2003, prices were bumped 10% in March, another 10% in September, and then another 10% throughout 2004. And throughout that period of time, Norbert Lou's sort of pricing power, latent pricing power theory was actually proven correct. As the prices were being bumped up by the company for this brand of beer, the overall volume was actually still going up as well. So there wasn't any notable impact at all on sales volume, even with pretty significant price increases. Now, interestingly, there was actually an ADR listed in the US for Quinsa, I guess a little bit like some of the Chinese technology companies today, like Alibaba, JD.com, and so on. They have American depository receipts listed on American stock exchanges. So Norbert Lou was able to access ownership in the company kind of through that vehicle, and he put on a 15% position in the Punchcard Capital portfolio in August of 2004, paying $17 per ADR. In 2004, the company's EBITDA grew 48%. In 2005, it grew another 40%. Prices kept increasing, volumes kept growing, and the operating kind of margins here for this business kept expanding very rapidly. Following that, quite a few things happened. Firstly, Norbert Lou increased his position to about 20% in the fund, so he bumped it up slightly. He actually then wrote the company up on the Value Investors Club and shared this idea kind of publicly, and that's a decision that he actually later regretted. It ended up bumping the share price up. It was a reasonably illiquid stock, so even a few kind of marginal buyers were pushing the share price up, and it meant that Norbert Lou, as he continued to add to his position, probably paid more for the shares than he would have had to if he didn't do that write-up. It was actually so illiquid, and Norbert Lou was so kind of focused on having this idea as a big chunk of the portfolio that Norbert Lou was actually turning down new investors and new capital wanting to join his fund. He said he kind of didn't have really a good second or third or fourth best idea. This was his first best idea, and he didn't want to have it watered down by having new money flow into the fund and having to try and allocate it elsewhere. Now, in early 2006, the price per ADR had risen to $37.65, making it a little more than a 2x at the time for Norbert Lou, at least compared to what he paid on his first lot of shares. And at that point, the family made the decision to sell their shares in this kind of put-call arrangement that they'd had with Ambev for some time. And using the formula that Norbert Lou had discovered in some of those SEC filings, the family sold their shares for $67.07. So a pretty massive bump upwards from what Norbert Lou had initially paid, but it left quite a bit of uncertainty around what was going to happen with the minority shareholders. Now, the family owned a huge chunk of the company. The shares, outside of family ownership only represented about 9% of the business. So there was quite a bit of uncertainty about whether those minority shareholders would get the same deal. Norbert Lou said in this article, it's not like you were going to be a silent partner alongside Buffett. And he actually ended up buying more. He made it a 40% position in the fund. But there was starting to be quite a bit of uncertainty about whether the minority shareholders like Norbert Lou and Punchcard Capital would actually get that same $67 deal as the family got. So next up came a kind of foray for Norbert Lou into a bit of activist investing. He actually teamed up with some of the other larger minority shareholders in Quinsa. At the time, after making it a 40% position in the fund, Norbert Lou was actually the largest investor in that company other than the kind of big family ownership stake, and they actually went somewhat public with their concerns. They were trying to essentially structure it in a way to where it would be a very bad kind of press situation if Ambev sort of ripped off the minority shareholder. So late in 2006, the minority shareholders got the exact same offer of $67.07 per share, but by that time, the sort of underlying performance of the business had actually continued to improve pretty significantly. And at that point, Norbert Lou actually flew to Argentina to argue his case, basically saying that if you were to rerun the numbers through the exact same formula, that was used to calculate the original $67 offer that the family did, the number per share would be much higher because the business is now producing more cash than it was when that $67 initial offer happened. So the kind of final part of the story is that in December 2007, the minority shareholders, including Norbert Lou and Punch Card Capital, accepted an offer for $82.50 per ADR, which made it nearly a 5x investment in just over 3 years. Now for me, there is a huge amount to learn from this story for Norbert Lou. I've tried to strip it down to basically 5 different points here. The first one is learn from Charlie. Charlie Munger, shared this reverse engineering of Coca-Cola. Norbert Lou referred to it as basically the best stock write-up ever, even though that probably wasn't really the point from Charlie Munger. And Norbert Lou was able to apply a lot of the Coca-Cola type ideas to, a beer company in Argentina of all things, and it did great things. So that's the first one. The second one is ignore the macro. Argentina was kind of a scary place to invest at the time. It arguably still is today. Yet this company had a lot of things that made it really quite indestructible, and it made Norbert Lou comfortable to invest in the company at a much cheaper price than he could buy beer companies in other parts of the world. Thirdly, there's a big focus on brand and pricing power. Fourthly, we have management incentives. For the very first time, there was a catalyst in place for management to increase prices and increase the operating margin and profitability of the business. And fifth and finally, not all investors are gonna get to a situation where they can do this, but given the opportunity, Norbert Lou did make his voice known. He got somewhat actively involved in the company here, and even little minority shareholders can make a difference there from time to time. So that is the first of our 3-part series here, looking at some of Norbert Lou's best ever investments. If you did enjoy it, be sure to subscribe to the channel so that you can see part 2 and 3 when those are out as well. And if you're interested in checking out what some other super investors have been buying, like Warren Buffett, check out the first link in the description. That will take you to Simply Wall Street, where you can see a top 5 curated list put together by me of some of Warren Buffett's most interesting stock purchases in 2022. It will show you some basic information about the companies. It will obviously give you the company names, and it will give you some of the reasons that I've personally put together around why I think Warren Buffett is so interested in those companies. And if you're interested in signing up to the Simply Wall Street platform to do your stock analysis, that link will get the first 100 people to use it a 40% discount on the unlimited plan. Thank you all very much for watching today's video, and I'll see you on the next one. Cheers.